If you have a considerable disposable amount in your hands, then investing it in schemes that offer regular monthly income is a great idea. This ensures that your idle money starts paying out dividends or earns profits. In this video, we share the best investments in 2021. So if you're interested, just keep on watching. Hello guys, welcome back to our channel. On this channel, we talk all about making money, saving money, and investing money. On the road to financial freedom. So, if you're interested in learning more ways on how to make, save, and invest money, make sure you subscribe to our channel and turn your post notification bell on. That way, you'll be notified every single time we post a new video. Are you ready? Yeah, we think you are. Let's go. Why invest? Investing can supplement your income, fund your retirement, or even get you out of a financial bind. Above all, investing increases your wealth by assisting you in meeting your financial objectives and increasing your purchasing power over time. Or perhaps you've recently sold your home or received a windfall. Allowing your money to work for you is a wise decision. While investing can help you build wealth, you must balance potential gains with the risks involved. And you'll want to be in a financial position to do so, which means you'll need manageable debt, an adequate emergency fund, and the ability to ride out market ups and downs without having to access your money. There are numerous ways to invest, ranging from safe options like CDs and money market accounts to medium risk options like corporate bonds and even higher risk picks like stock index funds. That's great news because it means you can find investments that provide a range of returns while also fitting your risk profile. It also means that you can mix and match investments to create a well-rounded and diversified and thus safer portfolio. Number 1. Certificate of Deposit, CDs. Banks and other financial institutions, such as credit unions, offer certificate of deposit. Customers agree to make a lump sum deposit for a set period of time in exchange for regular interest payments. Each institution has its own set of terms, including the interest rate and any penalties for early withdrawal. CDs are regarded as risk-free investments because they are generally federally insured. As a result, interest rates are typically very low, if not slightly higher than typical savings rates. Including certificates of deposit in your monthly investment income strategy will lower your portfolio's overall risk profile. Number 2. High-yield savings accounts. A high-yield online savings account pays you interest on the cash balance in your account. And, like a savings account earning pennies at your local bank, high-yield online savings accounts are easily accessible vehicles for your money. Online banks typically offer much higher interest rates due to lower overhead costs. Furthermore, you can usually get your money by quickly transferring it to your primary bank or by using an ATM. A savings account is a good option for those who will need cash in the near future. Best investment for. A high-yield savings account is ideal for risk-averse investors, particularly those who need money quickly and want to avoid the risk of losing their money. Risk. Because the banks that provide these accounts are FDIC insured, you don't have to worry about losing your deposit. While high-yield savings accounts, like CDs, are considered safe investments, you risk losing purchasing power over time due to inflation if rates are too low. Liquidity. Savings accounts are about as liquid as it gets for your money. You can add or remove funds at any time, though your bank may legally limit you to no more than 6 withdrawals per statement period if it so chooses. Number 3. Municipal bonds. Municipal bonds, another investment that pays interest every 6 months, are regarded as extremely low risk. At 0.01%, the 10-year default rate is roughly half that of corporate bonds. Some municipal bonds are tax-exempt, which makes them even more appealing. Municipal bonds are classified into two types: general obligation bonds and revenue bonds. General obligation bonds are used to fund ongoing expenses, whereas revenue bonds are used to fund infrastructure projects. Municipal bonds, like all of the other bond types on this list, can be purchased through a bond broker or through an investment fund such as a mutual fund or ETF. Number 4. Short-term corporate bonds funds. Corporations may raise funds by issuing bonds to investors, which can then be packaged into bond funds that own bonds issued by hundreds of corporations. Short-term bonds typically have maturities ranging from 1 to 5 years, making them less susceptible to interest rate fluctuations than intermediate or long-term bonds. Corporate bond funds can be an excellent choice for investors seeking cash flow, such as retirees or those seeking to reduce overall profile risk while still earning a return. Best investment for short-term corporate bond funds may be appealing to risk-averse investors seeking a higher yield than government bond funds. Risk. Short-term corporate bond funds, like other bond funds, are not FDIC insured. Investment-grade short-term bond funds frequently outperform government and municipal bond funds in terms of returns. However, the greater the rewards, the greater the risk. There is always the possibility that a company's credit rating will be downgraded or that it will run into financial difficulties and default on the bonds. To mitigate this risk, ensure that your fund is comprised of high-quality corporate bonds. Liquidity. Every business day, you can buy or sell fund shares. Furthermore, you can usually reinvest income dividends or make new investments anytime. Simply keep in mind that capital losses are possible. Number 5. Money market funds. Money market funds are mutual funds and exchange-traded funds that invest in cash and near-cash equivalents. These funds are extremely liquid, with a net asset value, or NAV, of $1 per share. Any surplus earnings are distributed to shareholders on a regular basis. Money market funds are classified in 4 types. Investing in non-government debt is considered prime. Government purchasing government securities and repurchase agreements. Treasury, investing in government-issued debt in the United States. Tax exempt, investing in tax-free assets such as municipal bonds. Because money market funds must maintain a $1 NAV, they are compelled to make regular payments to their investors, resulting in a consistent stream of monthly income. Number 6. Dividend stock funds. Stocks that pay dividends can make your stock market investments a little safer. Dividends are portions of a company's profile that can be distributed to shareholders on a quarterly basis. With a dividend stock, you will not only perform from long-term market appreciation, but you will also earn cash in the short term. Individual stock purchases, whether or not they pay dividends, are better suited for intermediate and advanced investors. However, you can reduce your risk by purchasing a group of them in a stock fund. Best investment for dividend stock funds are a good choice for almost any type of stock investor, but they may be better for those seeking income. Those in need of income and willing to invest for longer periods of time may find these appealing. Risk. Dividend stocks, like any stock investment, carry some risk. They are thought to be safer than growth stocks or other non-dividend stocks, but you should choose your portfolio with caution. Invest in companies with a track record of increasing dividends rather than those with the highest current yield. That could be an indication of impending trouble. However, even well-regarded companies can be hit by a crisis, so a good reputation is no longer a guarantee that the company will cut or eliminate its dividends. Liquidity. You can buy and sell your fund on any day that the market is open, and quarterly distributions are liquid. A long-term investment is essential for getting the best return on your dividend stock investment. Dividends should be reinvested for the best possible returns. Number 7. Floating rate funds. A floating rate fund is a mutual fund or exchange-traded fund, ETF, that invests in bonds, bank loans, and other interest-bearing assets. Variable or floating interest rates are paid by these funds. Floating rate funds are more likely to invest in short-term assets. Floating rate exchange-traded funds include the following: SPDR Barclays Capital Investment Grade, iShares, Floating Rate Bond ETF, Invesco Variable Rate, Investment Grade ETF, Floating Rate ETF. Floating rate funds can invest in both short and long-term debt securities, and fund investors are exposed to the credit risk associated with the fund's underlying investments. Number 8. Government bond funds. Government bond funds are mutual funds or exchange-traded funds, ETFs, that invest in debt securities issued by the United States government and its agencies. T-bills, T-notes, T-bonds, and mortgage-backed securities issued by government-sponsored enterprises such as Fannie Mae and Freddie Mac are among the debt instruments in which the funds invest. These government bonds are ideal for low-risk investors. These funds are also suitable for first-time investors and those seeking cash flow. Best investments for: government bond funds may be suitable for risk-averse investors, though some types of funds, such as long-term bond funds, may fluctuate significantly more than short-term funds due to interest rate changes. Risk: government debt funds are regarded as among the safest investments because the bonds are backed by the full faith and credit of the United States government. However, the fund, like other mutual funds, is not backed by the government and is subject to risks such as interest rate fluctuations and inflation. When inflation rises, purchasing power can fall. If interest rates rise, the price of existing bonds fall. If interest rate falls, the price of existing bonds rises. The price of existing bond rises. Long-term bonds have a higher interest rate risk. Liquidity: bond fund shares are extremely liquid, but their value varies depending on the interest rate environment. Number 9. Real Estate Investment Trusts, or REITs. REITs own income-producing properties and distribute 90% of their profits to shareholders. Investing in REITs is a simple way to invest a small amount of income-producing real estate, and there are many that pay monthly dividend income. There are many different types of REITs, each specializing in a different type of property, region, or sector. Some REITs invest in mortgages secured by real estate and earn interest income from them. REITs can be purchased directly or through exchange-traded funds. In either case, they are highly accessible, liquid, and generally quite stable investments. We take pride in the quality of our audience and your desire to actively improve your finances, so we want you to join the conversation. Your turn. Which one was your favorite? Did I miss any? Leave me a comment below. Now, for those of you still watching, you're a true money finder. Of course, there's a bonus waiting. Royalty Income Trusts. Royal income trusts are a great way to add monthly income from natural resource production to your portfolio. RITs are established to hold rights to deposits, oil wells, coal mines, and other energy-producing assets. The trust unit holders receive regular monthly income from the operation of the underlying energy assets, and the trust is terminated once the asset has been depleted and is no longer producing. Royalty trusts pay higher dividends than average, and there are some tax advantages. Because RITs are a pass-through entity, they do not pay corporation tax, and in some cases, such as clean and renewable energy production, unit holders may be eligible for tax credits. Monthly income from royalty trusts can vary because it is dependent on production volumes and commodity prices, both of which can be volatile. All right, we work super hard on these videos, and we made these right here just for you. Go ahead, smash the like button, hit the subscribe button, ring little notification bell, and thank you so much for watching, and bye for now.